Do you own a stock that's in a coma? And by coma, I mean it's lost a lot of value since you purchased it? Well, have no fear because today I want to show you a fix it strategy for the stock that'll lower its break even and cost you nothing to do. Hey everyone, Tom Gentile here. Now, everyone hates losing trades. I don't care what kind of trader you are. No matter how well your rules are, no matter how good your strategy is, no matter how much you plan, execute, manage a trade, it's going to happen. The question is, can you fix a losing position? Now, before we get into it, keep in mind losses are part of trading. You've got to accept this as fact, or you're going to find out the hard way. Minimizing them is the key to consistency. But what if you have a stock that's gone array? Can you fix it? Can you fix that losing stock position? First thing you got to know is that if you do not have the belief that that stock is going to come back, best thing you could do is just close it up and move on. So that being said, the most common way to fix a losing trade is what's called dollar cost averaging. Now, dollar cost averaging works like this. I'm going to use Snapchat, which is the stock that recently has taken a huge tumble. Let's say you own 100 shares of Snapchat at 15 and it dropped to 11 very quickly like it did last week. You're down $4 a share in a position. That's roughly $400 on 100 shares of stock. Now, adding 100 shares of Snapchat at current prices will lower the break even of the trade. But what it's going to also do is although it brings it down, it also now requires you to hold 200 shares of stock instead of 100. Now, that's great because if Snapchat goes up, those 200 shares are going to bring you back to break even much faster. But if it continues to go down, you are now risking twice as much from that second buy-in of 100 shares. My CPR strategy will take the trade that you all currently have and create something similar to that, but you don't have to buy an additional 100 shares of stock. All right. What we're doing is we're doing a type of option strategy that's called a call ratio spread. Now, a call ratio spread involves buying a lower strike call and selling two higher strike calls using the same expiration. What we do is we look to do that for as little cost as possible. Now, on their own, call ratio spreads are risky because you're selling more options than you own. But the fact is, if you already own 100 shares of stock, it's going to look something like a bull call spread and a covered call together. All right. Now, if you can recall, if we own Snap at $15 a share, all right, we're already down on the position. So here's an example of applying the call ratio spread to the stock. As you can see on the screen, I'm looking at buying one of the 12 calls in September. I'm looking at selling two of the 15 calls in September. And I'm looking to do that for as little as possible. Here's how everything adds up. All right. If I purchase the 12 calls, last price was $1.94. If I buy one of those, that's good for 100 shares of stock. It's going to cost me $194. But if I sell two of the 15 calls, well, they're priced at $105 each. Selling two of those is going to bring in $210. The cost on this trade is actually a credit of $16 before commissions. And this is what it looks like when you put everything together. So on the screen, you'll see an entry debit of $1,484. This is the combination of the stock you currently own and, of course, the new trade that you've added on. It actually reduces the position by 16 bucks. Not much, but here's where it gets good. Take a look at the break even. The break even is not $15 where you originally own the stock. The break even with this position added now comes down to $13.42, quite a bit below that original stock price that you had. And you can see on the risk graph that it has both the quicker break even, but if things go wrong, it still drops as the original stock trade. So you don't have any additional risk because the position is morphed from more than just a simple stock purchase. And again, what if the stock moves lower? It's no different than if you owned the original 100 shares of stock. But if Snap were to move higher, that ratio spread kicks in. And if we move all the way back to $15, you now have a profit where originally you would be back at break even. Now, in conclusion, Option strategies are not just for creating low risk trades. They can also be used to repair losing positions, such as the example I just showed you. When done right, they can be added for no additional cost or risk. And they accomplish the break even on a trade much quicker than owning the stock itself. Keep in mind, like I said earlier, if you don't believe the stock in question is going to rebound, the best thing to do is simply exit the position and move on. I hope you guys all learned something about how you can take an option strategy and add it to a stock price to help lower your break even and do it without any additional money. All right. Tell me what you think. Add your comments below, and I'll be in touch with another video. We'll see you then.